Hello everyone, welcome to Dr. Lubingadi to YouTube channel. In this video today, I am talking about using technical analysis for crypto trading, how to use charts and indicators to inform trading decisions. Now, this tutorial is on how to use technical analysis for crypto trading, but you can also use this same technical analysis for forex trading, and you can also use the same technical analysis for stock trading. So, as I said earlier, I'm going to be showing you how to use charts and indicators to inform trading decisions. I will try to show some of the things I'm saying on the screen as much as I can, but if I cannot, then please follow me theoretically as I go on and explain in detail. Actually, it is assumed that the people I'm talking to have some basic knowledge of technical analysis, but they still want more. And if you're a newbie, you are welcome. I will try to explain it as far as possible. Technical analysis is a critical tool for cryptocurrency traders, for forex traders, and for stock traders. It allows them to analyze price movements and to make informed trading decisions based on historical data. This approach uses various indicators and it also uses chart patterns to predict future price trends. And this helps traders identify potential entry and potential exit points. I must say from the start that it is potential. I must say from the start that these are indicators. I must say that from the start that technical analysis help you to have a probabilistic view of the market. It looks at what have happened before in the market based on this chart. When the particular formation is seen in the chart, usually this is what happens, but it is not cast in stone. It doesn't happen 100% of the time, but about 60 to 80% of the time, that is what happens, and that is why it is very good for trading. Now, you may be asking me that if it is not accurate 100% of the time, why then are we talking about it? Nothing in forex or in crypto or in stock trading is 100% accurate. Most of the time, all you need to succeed is even about 50% accuracy, because if your risk reward ratio is 1 to 3 or even 1 to 2. So if you're able to win 50% of the time and you are having 3 to 1 or 2 to 1 and you're having the upper hand 50% of the time, you are winning, and then 50% of the time you are losing. So 50 times 2 is 100 and 50 times 1 is 100. So if you win 50 times 2 times, that means you have won 100. And if you lose 50 times 1 time, that means you have lost 100. And that means 100 minus 50 is going to give you 50. That means you've won and accumulated 50. And the same way, if your risk to risk reward ratio is 3 to 1 or 1 to 3, and the higher one is yours, that means if you are looking at 100, 50 multiplied by 3, that is 150. 50 multiplied by 1, which is your losses, that is 50. So you are winning, you are having 100 points in win. And that 100 points may be multiplied with whatever currency or whatever capital that you have, and you see that you are making headway. So let me look at understanding technical analysis. Technical analysis involves studying historical price data and trading volume to forecast future price movements. Unlike fundamental analysis, which focuses on the intrinsic value of an asset, technical analysis relies solely on market behavior. So it looks at market behavior in the past, and based on that, it tries to predict market behavior in the future. Now, let's look at the key concepts of technical analysis. The first thing is price action. Price action is the movement of a cryptocurrency's price over time. Is the foundation of technical analysis. Traders observe price movements to identify trends and also to identify reversals. Now, what do you mean by trend? Markets move in 3 primary trends: uptrend, that is bullish; downtrend, that is bearish; and sideways, that is range bound. Identifying the current trend is crucial for successful trading. Now, what are the essential tools for technical analysis? The first one are the charts. We have the line charts. These provide a simple view of price movements over time by connecting closing prices. We also have the candlestick charts. These offer more detailed information showing opening, closing, high and low prices for specific time frames, making it easier to identify market sentiment. Then let's look at what is referred to as indicators. One of the major and basic indicators that can be used for technical analysis is called moving averages. These smooth out price data to identify trends. The two most common types are the simple moving averages, a moving average, and the exponential moving average. Another type of indicator is relative strength index, RSI. This momentum oscillator measures the speed and change of price movements, helping traders identify overbought or oversold conditions. Moving average convergence divergence, MACD. This indicator helps traders identify potential buy and sell signals by analyzing the relationship between two moving averages. Then you also have the volume analysis. Volume plays a crucial role in technical analysis. High trading volume often indicates strong investor interest, confirming trends. Low volume may suggest weak price movements and potential reversals. Common chart patterns. Head and shoulders, that's number one. This pattern indicates a reversal trend, and it consists of three peaks: a higher peak, that is head, between two lower peaks, that is shoulders. It suggests that an uptrend may be reversing to a downtrend. Another common chart pattern is double top and bottoms. These patterns signal potential reversals. A double top occurs after an uptrend and indicates a bearish reversal, while a double bottom appears after a downtrend, signaling a bullish reversal. Another one of the common chart patterns is triangles. Triangular patterns, that is ascending, descending, or symmetrical, indicate consolidation periods where the price is tightening before a breakout. Traders often use these patterns to predict future price movements. Now, let me show you the strategies for using technical analysis. One of the basic strategies is to combine indicators. So you don't just use one indicator, you combine 2 or 3 indicators. Using multiple indicators can provide more reliable signals. For example, a trader may look for a crossover in the MACD alongside an RSI, leading to confirm a buy or a sell signal. Setting stop loss orders. That is another strategy for technical analysis. Technical analysis can help traders set appropriate stop loss levels to minimize risk. For instance, placing a stop loss just below a support level can protect against significant losses. Another strategy for using technical analysis is developing a trading plan. A solid trading plan based on technical analysis can guide traders in making disciplined decisions. This plan should outline entry and exit points, risk management strategies, and profit targets. Let me tell you, you have to develop your own trading plan. There's nobody that should develop your trading plan for you. If you are relying on other people to develop your trading plan for you, that means you don't know what you are doing, because what works for one may not work for another. So you must be able to develop your own trading plan, what works for you, and stick to the trading plan. As you go on, you are learning different things. You may be learning, and then your trading plan already is working for you. Don't be tempted to change it because of another one which may not work for you. Now, let's talk about the risks and limitations. Number one, thing we want to look at here is market volatility. Cryptocurrency markets are known for their volatility. The same thing with the forex market, the same thing with the stock market. And this volatility can lead to false signals in technical analysis. Traders must remain vigilant and adjust their strategies as needed. Now, let's talk about the psychological factors. Trading decisions can be influenced by emotions like fear and greed, potentially leading to irrational behavior. Maintaining discipline and sticking to a trading plan is crucial. Now, there are no guarantees in forex trading or in crypto trading or in stock trading. Technical analysis is not foolproof. Market conditions can change rapidly, and past performance is not always indicative of future results. That is in forex, that is in crypto trading, and also in forex trading and stock trading. So technical analysis is a powerful tool for cryptocurrency traders, providing insights into market trends and helping inform trading decisions. By understanding charts, indicators, and patterns, traders can develop effective strategies to navigate the volatile crypto market and the volatile forex market and the volatile stock market. However, it is essential to combine technical analysis with a solid risk management strategy and be aware of the inherent risks involved. So this is where I'm going to stop on this. If you have found value from this video, do well to subscribe, like, and share. I'm going to see you in the next one. Until then, bye.